Okay, so you want to own a shopping mall, 100 storefronts under one climate-controlled roof, a food court humming at lunchtime, a fountain in the center court where kids used to feed pennies, a business that once represented the absolute pinnacle of American retail real estate investment. You picture yourself as the landlord of an entire microeconomy, collecting rent checks from dozens of tenants simultaneously while shoppers wander from store to store all day long. That's the fantasy. Here's the actual business hiding underneath it. An industry that built roughly 1,500 enclosed shopping malls across America between the 1950s and the 1990s, then spent the following 3 decades watching a meaningful share of them die. Sometimes slowly, over a decade of declining tenancy, sometimes with startling speed. Once a single anchor department store closed and triggered a contractual chain reaction nobody outside the industry ever knew existed. Some mall owners have built genuinely durable, still thriving retail fortresses worth billions of dollars. Others own what the industry itself now bluntly calls dead malls. Structures too large to easily repurpose, and too empty to profitably maintain, sitting as some of the strangest, most visible monuments to changed consumer behavior in the entire American commercial landscape. By the end of this, you'll understand exactly why owning a shopping mall is one of the most structurally binary businesses in all of commercial real estate. A business where the exact same physical asset can represent one of the most valuable retail properties in America or a functionally worthless liability, with remarkably little middle ground between the two. What you're actually buying before the money makes sense. You need to understand that a shopping mall's ownership and revenue structure is genuinely more complicated than almost any other real estate asset examined throughout this series. Because a mall is rarely, if ever, owned as a single, unified property, the way an apartment building or an office tower typically is. The defining structural feature of the traditional American shopping mall is the anchor-tenant arrangement, where large department stores, historically names like Sears, J.C. Penney, Macy's, and Nordstrom, occupy the mall's largest spaces at the building's corners and ends, and critically, these anchor stores have historically owned their own physical space outright, or held extraordinarily long-term, favorable ground leases, rather than renting from the mall's central ownership entity the way smaller in-line tenants do. This arrangement made sense from the original developer's perspective, since a mall developer needed the guaranteed foot traffic a major department store would bring to justify building dozens of smaller storefronts around it, and offering an anchor of favorable ownership or lease structure, sometimes even paying the anchor to occupy the space, was the price of securing that foot traffic anchor in the first place. The mall's actual owner, the real estate entity most people picture when they imagine owning a mall, typically owns and leases out only the smaller in-line stores, the specialty retailers, food court vendors, and mall-based services that occupy the corridors connecting the anchor stores, along with the common areas, parking structures, and shared infrastructure, meaning the mall owner's revenue and profitability depend enormously on maintaining strong anchor tenant presence they frequently don't even own or directly control, a structural dependency that becomes the single most important fact in this entire industry once you understand what happens when an anchor decides to leave. The co-tenancy clause that triggers the collapse here is the single most consequential and most misunderstood mechanism in the entire shopping mall industry, and it explains why a mall's decline, once it genuinely begins, so frequently accelerates with startling speed, rather than unfolding as a slow, manageable process. The overwhelming majority of in-line retail leases at traditional shopping malls contain what's called a co-tenancy clause, a contractual provision that ties a smaller tenant's rent obligation, and in many cases, their entire right to remain open at all, to the continued operation of the mall's anchor stores and to the mall's overall occupancy rate remaining above a specified threshold. According to industry analysis of standard mall lease structures, these clauses commonly allow an in-line tenant to pay dramatically reduced rent, sometimes falling to a percentage of sales-only structure, with no fixed minimum rent at all, or in more severe cases, to terminate their lease entirely and vacate. The moment a specified anchor closes or the mall's overall occupancy falls below a contractually defined percentage, frequently somewhere in the 70 to 80% occupancy range. The single contractual mechanism is precisely why a mall's decline so often resembles a falling row of dominoes rather than a gradual fade. When one anchor department store closes, whether due to that specific retailer's own financial troubles or a broader chain-wide bankruptcy and store closure program, the co-tenancy clauses embedded throughout dozens of surrounding in-line leases can trigger simultaneously, either slashing the mall owner's rental income from those tenants overnight or giving those tenants the contractual right to leave entirely, which in turn drops the mall's overall occupancy rate further, which can then trigger a second wave of co-tenancy clauses in the leases of tenants whose triggers were tied to the occupancy percentage rather than to a specific anchor, a genuine cascading mechanism that has taken numerous American malls from a stable, profitable property to a severely distressed one within the span of just 1 or 2 years, following a single major anchor closure, a speed of decline that has surprised even experienced commercial real estate investors who assumed a property generating millions of dollars in annual rental income represented a fundamentally stable, slow-moving asset. The department store collapse that started it also understand why so many malls have found themselves genuinely vulnerable to this cascading co-tenancy mechanism over the past 2 decades. You have to understand the parallel, largely separate collapse of the traditional American department store industry that anchor tenants have historically represented. According to retail industry data tracked by organizations including the International Council of Shopping Centers and various commercial real estate research firms, chains including Sears, J.C. and numerous regional department store brands that once anchored the vast majority of American malls, filed for bankruptcy and closed hundreds of stores. Collectively, over the roughly 15 years following the 2008 financial crisis, a collapse driven by a combination of factors largely unrelated to any individual mall's own local market health, the broader shift of general merchandise and apparel spending toward e-commerce, and toward off-price and discount retail formats that department stores were structurally slow to compete against. Decades of underinvestment in the in-store shopping experience relative to increasingly sophisticated competitors, and in several notable cases, leveraged buyout and private equity ownership structures that loaded historically stable department store chains with substantial debt precisely during the period when their underlying retail business was already under genuine competitive pressure, a combination that accelerated bankruptcy timelines that might otherwise have unfolded more gradually. This department store collapse created a genuinely unusual structural problem specific to this industry. Because so many malls across the country depended on the exact same small handful of national department store chains as their anchor tenants, a single struggling retailer's chain-wide bankruptcy and store closure decision could simultaneously trigger co-tenancy cascades at dozens or even hundreds of individual malls across completely different, otherwise healthy local markets. Meaning a mall's fate became tied not just to its own specific location and management quality, but to the entirely separate, largely uncontrollable fortunes of a small number of national retail chains whose own business struggles had essentially nothing to do with how well any individual mall owner had run their particular property. The cost of actually building and maintaining the thing, even setting aside the anchor and co-tenancy dynamics. Shopping malls require a genuinely enormous ongoing capital commitment simply to remain physically and competitively viable. According to commercial real estate cost data tracked by industry publications, building a new enclosed regional mall historically required capital investment running into the hundreds of millions of dollars, a scale of investment that essentially stopped happening in the United States after the early 2000s. As developers recognize the format's structural decline, meaning virtually every mall operating in America today presents an aging asset requiring substantial, ongoing capital reinvestment simply to remain competitive against newer retail formats, rather than a recently built facility. Common area maintenance, the climate control systems, escalators, elevators, parking structures, and shared corridor infrastructure that mall owners are contractually responsible for maintaining under most lease structures, represents a substantial and genuinely unavoidable ongoing cost category. Since HVAC systems sized to climate control an enclosed structure spanning hundreds of thousands or millions of square feet require enormous, continuous energy expenditure and periodic, extremely expensive, major equipment replacement, and a mall that allows this infrastructure to visibly deteriorate accelerates exactly the kind of declining foot traffic and tenant confidence that can trigger the co-tenancy cascade discussed earlier. Periodic renovation and repositioning represents an increasingly necessary and increasingly expensive capital category for any mall hoping to remain competitive. Since the retail industry has moved substantially toward open-air and mixed-use formats over the past 2 decades, meaning even a physically sound, well-maintained enclosed mall increasingly requires substantial capital investment to convert portions of its footprint toward the entertainment, dining, and experiential retail concepts that have become essential to drawing shoppers who now have e-commerce readily available for straightforward merchandise purchases. A repositioning that can cost tens of millions of dollars for even a partial renovation of a single property. Property tax represents a genuinely significant, and for a declining mall, particularly punishing cost category. Since a mall's property tax assessment is typically based substantially on its historical income-producing value, meaning a mall experiencing declining occupancy and rental income can still face a property tax bill calculated against its earlier, healthier financial performance for a period of time before assessments catch up to the declining reality, creating a genuine cash flow squeeze precisely during the period an owner can least afford it. How the money actually comes back. Revenue models across healthy versus struggling malls reveal genuinely different underlying economics. And understanding this divergence explains why the shopping mall industry has become so sharply bifurcated between clear winners and clear losers over the past 2 decades. Class A malls, the industry's own terminology for the highest performing properties, typically located in affluent, densely populated markets with strong demographic fundamentals, continue commanding genuinely premium rents. And according to data tracked by the International Council of Shopping Centers, the strongest performing regional malls have maintained sales productivity, revenue generated per square foot of leasable space, that not only held up, but in many cases grew over the past decade, as these properties successfully repositioned around dining, entertainment, and experiential tenants that give shoppers a genuine reason to visit, that pure e-commerce convenience can't replicate, while simultaneously benefiting from the exact same department store struggles that devastated weaker malls. Since these prime properties could often successfully replace a struggling department store anchor with a more contemporary, higher-performing tenant, sometimes even multiple smaller tenants, subdividing the former anchor space, precisely because their strong underlying market fundamentals made that space genuinely desirable to replacement tenants. Percentage rent, an arrangement common at healthier malls, where tenants pay a base rent plus an additional percentage of their sales above a specified threshold, provides mall owners at strong-performing properties with genuine upside participation in their tenants' success. A revenue structure that functions considerably better for the mall owner during genuinely strong retail sales periods than a pure fixed rent structure would. Precisely the kind of favorable lease economics that strong Class A malls can command, given the genuine demand from retailers wanting to be present in these specific high-traffic locations. Struggling B and C malls, by contrast, according to the same industry data, have experienced substantial, sustained declines in both occupancy and per square foot rental rates, with many properties in this category increasingly dependent on considerably lower margin tenant categories, discount retailers, temporary and pop-up leasing arrangements, and in many cases, entirely non-retail uses, including medical offices, educational facilities, and government service centers, that mall owners have increasingly leased space to, specifically, to maintain some baseline occupancy and cash flow in as traditional retail tenant demand for the property has genuinely evaporated, a fundamentally different, considerably less profitable revenue model than the traditional shopping mall business the property was originally built to operate. The volatility nobody wants to talk about beyond the anchor dependency and co-tenancy mechanisms already discussed. Shopping mall ownership carries several other distinctive, ongoing risks. E-commerce competition represents a genuine, ongoing structural headwind specific to this industry in a way that has no clean parallel in most other commercial real estate categories. Since online retail has captured a steadily increasing share of total American retail spending over the past 2 decades, meaning even a well-managed, well-positioned mall competes against a channel that didn't meaningfully exist when the mall was originally built and that continues capturing spending, specifically in the general merchandise and apparel categories that traditionally anchored mall-based retail. Demographic and market shift risk represents a genuine, often underappreciated vulnerability specific to individual mall properties. Since a mall's fundamental viability depends heavily on the surrounding trade area's population density, income levels, and demographic trajectory remaining stable or growing, and a mall built decades ago to serve a specific suburban trade area can find its underlying market fundamentals genuinely deteriorating if that surrounding area experiences population decline, income stagnation, or simply loses relative appeal to newer, more desirable suburban and urban retail and residential development elsewhere in the same broader metropolitan area. Redevelopment and repurposing risk represents a genuinely distinctive challenge specific to this asset class once a mall's traditional retail viability has clearly deteriorated. Since converting a large enclosed mall structure to alternative uses, residential, industrial, mixed-use development, or outright demolition, involves substantial capital investment and genuinely complex zoning, environmental, and structural challenges specific to a building type that was never designed with any use other than enclosed retail in mind, meaning a genuinely struggling mall owner frequently faces a difficult choice between continuing to operate a declining, increasingly unprofitable retail property, or investing substantial additional capital into a genuinely uncertain redevelopment process with no guarantee of success. An REIT and institutional ownership concentration represents a structural dynamic specific to how this industry's ownership has evolved. Since a substantial share of America's shopping malls, particularly the largest, most prominent regional properties, are owned by a relatively small number of large, publicly traded real estate investment trusts, meaning the financial health of these specific companies, their debt levels, their capital allocation decisions, and their own strategic priorities regarding which properties to invest in versus which to allow to decline, has an outsized influence on the broader industry's trajectory that individual mall-level management quality alone doesn't fully explain. The real case study, the fall of the American Dream Mall model and CBL Properties, understand how directly these structural risks can threaten even a substantial, established mall ownership company. What happened to CBL and Associates Properties, once one of the largest owners and operators of regional shopping malls in the United States, focused specifically on malls in mid-sized American markets, precisely the kind of secondary, less affluent trade areas that proved considerably more vulnerable to the department store collapse and co-tenancy cascade dynamics discussed throughout this analysis than the strongest, most affluent Class A properties concentrated in major coastal and metropolitan markets. CBL had built its portfolio substantially around exactly the mid-market regional mall model that anchored department stores like Sears and JCPenney had historically been essential to. And according to the company's own public financial disclosures and subsequent bankruptcy filings, the cascading effect of multiple simultaneous anchor bankruptcies across its portfolio during the late 2010s triggered widespread co-tenancy clause activations across numerous properties simultaneously, a company-wide version of exactly the single property collapse mechanism discussed earlier, compressing rental income across a substantial share of the company's entire portfolio within a remarkably short period. The company filed for Chapter 11 bankruptcy protection in November 2020, a filing whose immediate trigger was substantially accelerated by the COVID-19 pandemic's temporary closure of physical retail broadly, but whose underlying vulnerability, according to extensive industry and financial analysis of the company's situation, had been building for years before the pandemic arrived. Driven by the exact combination of anchor department store closures and cascading co-tenancy clause activations across a portfolio concentrated specifically in the secondary, mid-market trade areas that had proven structurally more vulnerable to these dynamics than the strongest class of properties elsewhere in the industry managed to remain. CBL successfully reorganized through the bankruptcy process, emerging with substantially reduced debt and a more focused, smaller portfolio. But the company's experience illustrates a genuinely important structural lesson specific to this industry. Unlike many of the other capital-intensive businesses examined throughout this series, where operational excellence at the individual property level provides meaningful protection against broader industry headwinds, a shopping mall's fate depends substantially on structural factors. The specific anchor tenants own separate corporate fortunes, the co-tenancy mechanisms embedded in decades-old lease agreements, and the surrounding trade area's demographic trajectory that individual mall-level management quality alone frequently cannot fully overcome. Meaning, in a professionally managed, institutionally owned portfolio of shopping malls can face genuine, portfolio-wide financial distress driven by dynamics that originated entirely outside any individual property's own operational control. Two scenarios. Let's build the honest math, the way an actual owner has to run it. In the good scenario, you own a Class A regional mall in a genuinely affluent, densely populated, growing trade area with a diversified anchor tenant base that has successfully evolved beyond traditional struggling department stores toward a mix of strong-performing retailers, entertainment concepts, and experiential dining that gives shoppers a genuine, e-commerce-resistant reason to visit. And your lease structure includes meaningful percentage rent participation that lets you benefit directly from your tenant's strong sales performance rather than relying purely on fixed base rent. Your property has maintained occupancy well above the thresholds that would trigger co-tenancy clause cascades across your in-line tenant base. And your sales productivity per square foot has remained strong or even grown as your property successfully positioned itself as a genuine destination rather than simply a collection of stores, allowing you to command premium rents from retailers who specifically want presence at your specific location given its proven strong performance. A property operating at this level, according to industry data on the strongest performing regional malls, can generate genuinely attractive, stable cash flow and continue appreciating in value even as the broader industry narrative around dead malls dominates general media coverage. Precisely because these strongest properties represent a genuinely different, considerably more insulated business than the struggling majority of the industry's overall property count. Now, the harder scenario. You own a mid-market regional mall in a secondary trade area that has depended, as the vast majority of malls built during the format's peak construction era did, on traditional department store anchors that have since filed for bankruptcy and closed their locations at your property, whether through a company-specific financial collapse or a broader chain-wide store closure program entirely disconnected from your specific market's health. The resulting co-tenancy clause activations across your in-line tenant leases trigger a rapid cascade, dramatically reducing your rental income from surviving tenants while simultaneously giving others the contractual right to vacate entirely, and your occupancy rate falls below additional co-tenancy thresholds embedded in a second wave of leases, accelerating the decline further within a remarkably compressed timeframe. Your property tax assessment, still calculated against your mall's earlier, healthier financial performance, hasn't yet caught up to your declining reality, creating a genuine cash flow squeeze precisely as your rental income is collapsing, and you face a genuinely difficult choice between committing substantial additional capital toward an uncertain repositioning or redevelopment effort, or managing a continued, likely accelerating decline toward the kind of severely distressed, largely vacant property the industry bluntly refers to as a dead mall. The gap between these two scenarios isn't a modest variance in a leasing forecast. It's the difference between one of the most attractive, still thriving commercial real estate asset classes available and a genuinely difficult, potentially near worthless liability. And which scenario a given mall falls into depends overwhelmingly on trade area demographics and anchor tenant health that were substantially determined by decisions made decades before the current owner ever took control, rather than by any operational excellence the current owner brings to running the property day to day. That the real payoff, the difference between mall owners who have preserved and grown genuine, lasting wealth in this business, and those who have watched a once valuable property collapse into a dead mall, comes down to a small number of structural realities more than purely operational choices. A lesson with clear parallels to what we found examining the newspaper industry's own structural collapse earlier in the series. Diversifying anchor tenant dependency away from the specific handful of traditional department store chains that have proven so vulnerable to industry-wide collapse, toward entertainment, dining, and experiential tenants whose underlying business model doesn't face the same direct e-commerce substitution risk, has proven to be one of the clearest differentiators between malls that have successfully navigated this transition, and those still structurally dependent on exactly the anchor category that has collapsed most dramatically across the broader industry. Understanding, with genuine clarity, that a mall's fundamental viability depends substantially on trade area demographics and market positioning that existed largely independent of, and prior to, current ownership's own management decisions, matters enormously for anyone evaluating this specific asset class. Since the co-tenancy cascade mechanism means a mall's decline, once genuinely triggered, can unfold with a speed that gives even skilled, well-capitalized ownership relatively little practical opportunity to reverse the underlying trajectory through operational improvements alone. And recognizing that the traditional enclosed mall format itself, the very physical structure that made this business model work for decades, has become a genuine structural liability for a meaningful share of the industry's total properties, meaning some owners have found that the most economically rational strategy isn't attempting to preserve the traditional shopping mall business at all, but rather pursuing genuine redevelopment toward entirely different uses. Represents an increasingly important strategic recognition that echoes the broader theme running throughout this series. The physical asset itself was never really the business. Understanding what that asset's genuine, durable underlying value actually depends on, and having the discipline to act accordingly before a slow decline becomes an unmanageable cascade, is what has separated this industry's genuine long-term winners from its now numerous cautionary tales. The romance of the mall, the memory of a genuinely vibrant American retail and social institution that an entire generation grew up visiting, is genuinely real, and it's precisely the properties that evolved fastest and most decisively away from that original, now vulnerable format, while preserving what still genuinely works about bringing people together in a shared physical space, that have built something that continues generating real value today. Which means the honest answer to whether owning a shopping mall can build genuine, lasting wealth is yes, unambiguously. For the smaller number of Class A properties and disciplined operators who recognize the structural transition early enough to act on it. But for the majority of the roughly 1,500 enclosed malls built across America's peak retail construction era, the industry's own history has made increasingly, sometimes brutally clear that the fountain in the center court, however fondly remembered, was never actually what determined whether that specific mall would still be standing, thriving, and profitable a generation later. And subscribe.